tell me how this came about. The whole story of the crash of '87, and why did you see it coming? And you got famous after calling it. And tell me what transpired, the story of the crash of '87 and Peter Grandich.
Sure, like you, I was a young man. I actually was a warehouse manager, took a small amount of money, turned it into a large sum, only to lose it through a penny stockbroker, and that's what actually...
I'm sorry, Peter. I didn't mean to lose all your money there.
I changed the name a little bit of the firm. I called them Rob Them Blind Robinson, but they were... back then, penny stock firms were all around. And so I became a stockbroker in March of 1984. By June of '84, I wanted to quit because I couldn't make cold calls. In fact, I remember, and I was laughing driving down here listening to your early part of the show, when the first product I had to sell was a 10-year, 15% CD, and people were telling me, the ones that didn't hang up, that's too little amount of a CD. So I was thinking, boy, have things changed. And so here I was, started a newsletter in lieu of having to call people, got myself onto some TV shows, Financial News Network before there was CNBC, and I got elevated at a New York Stock Exchange member firm to head of investment strategy.
How old were you?
Oh God, I was 1987. I was born in '56. So what does that make me?
I don't know. I'm only an accountant. I can't figure it.
31. I was in the business less than 4 years, and it had several offices, 210 brokers. And in August of 1987, I just wrote something that said there's going to be a stock market crash and I would sell everything. And the irony was the firm didn't get happy that I was getting some press about that. In fact, they asked me to retract it or resign. And they gave me a long dissertation, take too long to explain why I needed to retract it. I refused. And then, of course, October 19th, 1987 came. And you were speaking earlier about the day after, which I would go into the office that morning and say that I believe what occurred the day before will be the worst behind us, and in 2 years there'll be a new all-time high. So if anybody didn't think I was crazy before that crash, they certainly thought on the morning of October 20th. And an interesting thing that you brought up, and a little bit more detail on it, around 1 o'clock on October 20th, over half the Dow stocks had still not opened up. There was still selling pressure. So they shut the Chicago Board of Trade S&P futures pit, but they kept the one in Kansas City open, which was always a much smaller, for every 10 that traded on the Chicago, 1 traded on the Kansas City. And then miraculously, within 17 minutes, 11 of the biggest firms at that time all decided it was a good time to buy futures. And they drove the future market up 1,300 points in less than 10 minutes. That's, was equivalent to Dow 30. And that's what opened up all the rest of the Dow stocks and really saved the day.
Well, don't you think that was government, Federal Reserve intervention of some kind?
There's no government intervention. I don't know what you're talking about. but it was a miraculous timing.
Oh, yeah.
It was miraculous timing, and that saved the market. And we've been up tens of thousands of points since then. And I don't know to this day, I don't think it was experience, because I was only in the business 4 years. I don't think it was any special formula or things. I think because of what transpired in my life afterwards, I certainly believe it was inspired by the creator of all that's good in the universe for reasons that only have become known in my latter part of my career. And but as you also noted, I said last week to those that still listen to me that this anniversary, which was Tuesday, is going to be a walk in the park compared to what I think is going to happen in the market going forward. So as bad as that was and as scary as it was, I think there's far more, a whole host of reasons, political, social, and economic, to think that there's a strong possibility that we could see something even far more severe. And unlike then, we're not in a position to easily recover from it.
So I want to expand on that as we go through the last half hour of the program here. I want to get back, though, to your history, because after you came out with that, and then the buy recommendation the day after, you became known as the Wall Street Whiz Kid. And you were on all kinds of television shows, and it led to a lot of things for you.
Well, and a couple good, and I like to take the time to share on that here in a moment. Yeah, you're right. I got interviewed by, at the time, Steve Crowley, who was the head, he was the business editor for Good Morning America, and he gave me that moniker, the Wall Street Whiz Kid. And it was because, I didn't finish high school. I never took a formal day of education, and there were a lot of people that claimed afterwards that they called that crash, but they really weren't. But we were emphatic about it, and yeah, I ended up. I went to work for a firm called AFM Investments, in fact, and I need to say, if I may stop here, I'm well past. I'm in the last time of my twilight of my career. I have nothing to brown nose you for other than to talk the truth. It was the single best time. I miss it dearly. I sit here and I remember we started. I had a television show at the time. We went live. Someone told a joke a couple of minutes before, and I literally had to walk off because I was the host. You took over, and your media career has taken off ever since. So I think I'm actually due a royalty now that I think
You probably are. Well, you got me started in media. You started getting me on your TV shows early on, the public access and then the cable show and Cablevision. And I could not speak in front of 5 people without being frightened, like average Americans who public speaking is the last thing they want to do. And you broke that in me. You gave me a comfort zone where I was able to not only not be panicked about it, but start thriving doing it. I enjoyed it. So I give you a lot of credit for getting me started in media.
So praise be to God, you've done tremendous. I look at your desk there. I can imagine the hours that you take to prepare to do this show. People think 5 minutes, and it is 5 minutes is a long time to be interviewed. To go 2 hours and do it every week, that's no easy feat. But getting back to what you've talked about and getting to where we are, the way I would subscribe it is, I'm approaching 40 years like you around this. I don't believe America has ever been in a worse social, political, and economic environment. I don't think the country's been more divided, other than possibly going into the Civil War. And because of that division that goes across socially, political, and economic bounds, I think when the inevitable bust of the all-time financial bubble, there's no question this is the biggest bubble in man's history, in my view. Inevitably it breaks. Does it break now? Does it break 5,000 Dow points or whatever? When it does, the ability to recover from it or past ones that we've had during our career is nil. And I think we're going to go into a very long period where we're going to pay a very dear price for the excess that we've done both socially, politically, and economically.
So you believe that there's a significant risk of not just a correction in the market, but something far deeper?
First of all, I'll tell you my big, I don't even know if I had a chance to share this with you. To think that in past several years, Federal Reserve members, including the Federal Reserve Chairman himself, have been actively participating in the stock market. Now, Lou, let's be simple. Let's be realistic. If you and I were them, and you and I had a good part of our wealth in something, and some action we could take, meaning tightening or not providing all the liquidity and all that we know has been occurring, could greatly impact us suffering losses. Is that the easiest decision we're going to have to make, or one of the toughest of all time?
Well, it's not even a decision, just knowing what the decision is going to be. I mean, Wall Street parses the words of the Federal Reserve statement or the chairman's statement to try to get any kind of signal of where they're going with monetary policy. They know because they're in the private meetings and they're doing stock transactions that would benefit by the policy that they just voted on. Now, and almost every governor, including Powell, has done this. And now the Federal Reserve came out with guidelines this week that they can't trade their own account. Oh, they already made their tens of millions of dollars trading.
The horse is out of the barn.
You and I or anybody on Wall Street would give our right arm to know what they're talking about in those meetings.
Let me make another point that's very important and why I feel this way. So, about half of all people licensed to give financial advice. Now, not everybody licensed is actually giving advice. They're working in the back, administrator and all. They've only been licensed since the last financial crisis. And only about a third of all advisors have only been practicing since the new millennium. So one of the other issues that I believe we have to face is the lack of real experience, because basically it's been a one-way street during that time, interrupted by very short periods of time. And I always coin it as you've learned to drive on a one-way street. And everybody remembers what I'm about to say. Do you remember the first time you came to your first traffic circle? Do you remember what it felt like?
Yeah.
That you had to see not only oncoming traffic, but coming from different directions? We now have, in this last 18 months, internet gurus, people who were 2-3 years ago not involved in the stock market, and are now have 2 million viewers because they've developed a social media presence, who realistically, Lou, 3 or 4 years ago, the biggest mathematical challenge they had was in their algebra class in high school. And those are the people now who have become self-appointed and who have the audacity to look at someone like me and you, who've done this for 30, 40 years, who's been around the block once or twice, and tell us, you're archaic, you're a dinosaur, you don't get it, or take the ultimate saying that the God rest his soul, John Templeton, one of the greatest investors in history, said, it's never different this time. Yet the market is saying it is different this time. And let me just say that the one sentence you're never going to hear, certainly you've never heard up until now, whenever Wall Street gets so behind something, whether it was the internet stocks in 2000, the mortgage game in 2008, and now Bitcoin here in 2021. The sentence you never read after Wall Street has put the public in a big way into anything is, and the general investing public lived happily ever after. It's just never the last sentence. And I don't think it's going to be the sentence this time either, Lou.
So you, like me, believe that markets are way overdone to the upside. And this is the problem. And I'm having it as an advisor who deals with mainly seniors, conservative people. Conservative investors, since 2008, it's been like pulling teeth to make any money without taking an exorbitant amount of risk. Savings accounts, money market accounts, treasury bonds, corporate bonds, what have you, have yielded so low that they're not even keeping pace with inflation. So now either you have a choice. Either you're going to risk your money in the stock market, whose music could stop at any time and cause you substantial loss, or you just got to, suck it up and get low rates of return, or no rates of return in the case of a bank account. That's kind of like a devil's choice there, and it hasn't gone on for a year. It's gone on for 13 years or whatever it is, and I don't see an end in sight because, I want to know what your view is on this. Can the Federal Reserve? We're in an inflationary spike right now. And you've seen it coming. I've seen it coming for years. We were talking about it on this program. We have inflation now. If it's calculated the way it used to be calculated in 1980, we're at 12 or 13%. It was 15% back then. Paul Volcker raised interest rates to 18%, and here we are at 0%. Do you think the Federal Reserve is going to do what it takes to battle this inflation, raise interest rates, destroy the markets, or they're just going to let it run?
I don't know how the Federal Reserve can see interest rates increase dramatically. And by the way, not as dramatic as anywhere near that what it used to be. Because this case, when we look back when you and I started, we were the world's largest creditor nation. We're not that anymore. Okay, our GDP to debt ratio was around 30%. It's 135%, which really we can argue and show studies that show it's taking more and more debt just to produce a gross domestic product dollar. But having said that, we now have $30 trillion. I still find that hard to use a T, Lou. We thought B when we heard B when we were in business. That was a lot. But what's not counted in that, and it's hard for Americans to get their hands around this, is the United States decided to do something for its own self that it doesn't allow businesses to do. You and I in our business, if we have employees and we have unfunded liabilities, we have to fund that. We have to set money aside for that. The U.S. doesn't. So therefore, all the money that people are expecting to take care of Medicare, Medicaid, and Social Security, which some estimate is 70 to $100 trillion, without even talking about now the Medicare, how they want to expand it to everybody and make it larger and larger. How do we fund that? Well, let's just look back at the last year before the COVID. In 2019, the United States took in a little bit over $3.1 trillion in revenue. That's what it lives off, taxes. That's how it's able to do stuff. And paid about $440 billion in interest expense. Let's go to $30 trillion. And let's say interest rates just go back to 4 or 5%. Remember, I remember Mary and I going to look for our first condo in the first 80s, and we were happy. The realtor says, I think I can get you a 15% mortgage. Okay? So going back to 4 or 5% is not very large. Well, at 5% and at 30 trillion, Lou, what does that come to? 1.5 trillion in interest expense. And in our best year ever, we only took twice as much as that, and that's without paying the military, without paying anything. So it's inconceivable that if you do believe that interest rates are going to return back to normal, as they say and all, how do we continue to service our debt? And Lou, that's just debt on the national level. Remember, the states and cities don't have a printing press. They can't just create money out of thin air. And then there's the corporate debt. We've seen what corporate debt has risen to, especially on the junk side end. And then there's personal debt. So the dirty word, the 4-letter word, is debt. And there's a price to pay for it. And Lou, at our age now, it's going to be our children and our grandchildren are going to pay a bigger price for that than what we're going to. So I don't conceivably see how they can raise interest rates dramatically and keep things the way they are. And quite frankly, when you look at the social aspect and the political divide, if and when there's another crisis, Lou, the political parties are so divided they'll never be able to go in a room and come out of it anytime soon with a workable solution to whatever that financial crisis is.
We're talking with Peter Grandich, a good friend of mine and market guru. He's been in the business as long as I have, probably a little longer. And always has an interesting take on markets, politics, culture, and what's going on. So what you're saying basically is that the Federal Reserve is in a box. They can't do what they have to do to quell any kind of rampant inflation because they can't raise interest rates because of what you just said, which was government debt. But more importantly, it'll just crash the stock market. It'll crash the real estate market. Derivative markets, which we haven't talked about, which would blow up. It's a powder keg ready to blow.
I find still in the working with the public, I found it especially when I worked with athletes, but I stopped that because of all the social justice stuff that happened in the sports world. But I find still 6 to 7 to maybe 8 out of 10 families live in at least one financial level above where truly their finances support. And how do they do that? They borrow against the future. They live off of debt or they live beyond their means. And it worked while interest rates kept going lower because people could refinance and they can keep forestalling the inevitable principal amount. But now with inflation, clearly the genie's out of the box. And clearly the Federal Reserve knows that, okay? When you saw earlier this year junk bonds yielding less than the consumer price index, if you don't think that's a warning and you don't pay heed to that, you're just asking for trouble. You know this because you work so much with fixed income and people with seniors trying to preserve and try to keep some sort of lifestyle. The Federal Reserve destroyed the fixed income market. There really isn't a fixed income market anymore. People have had to resort. I live in a 55 over community in Freehold. And whenever I do go down to the community, all I hear is this from the folks. Hey, I don't care if my stock goes down 20, 25%. Please, God, don't cut the dividend because I need that dividend. And what people don't understand, if the economy does get really bad and it's heading that way, many of those corporations are not going to be able to keep paying that same dividend, okay? And they're going to look at not only percentage losses on their stock price, but they're going to see a cut in their ability. And then what do? So I don't see any easy solution, and I don't see any quick fix that's been able to be done before by the Fed. And what's most interesting, look at the two former Fed governors, presidents, who are no longer associated with the Fed and see what they're saying. Greenspan might as well be a gold bug at this point in time. What he's sharing about how bad things he sees, and even Bernanke. And for the short time that Yellen, when she was out and getting $1 million a speech, she was preaching really concerns. But now she's back in government, and things are hunky dory again. So I'm sorry, people don't like hearing this. People don't want to hear the negative stuff, especially when we're in the biggest financial bubble of all time. And let me just tell you this. When people look back and they look at all the different things, there was always something or a product and all that people got involved in. 2008, the financial service companies were actually selling those mortgages short to the people that were buying them. And people didn't understand what that meant. And I say to them, I put it in an easy term. Imagine if you heard car companies today not only built faulty cars that were going to crash, and also bought life insurance on the people that bought those cars, so they collected twice. Okay? Now, what you see that in this Bitcoin world, and people talking about, Lou, I know you'll agree with this, and I don't want you to if you don't, but the terminologies and predictions that people are making about Bitcoin now going up to 500,000, a million, we heard that about penny stocks in the 80s and 90s, and they threw people out of the business for making predictions like that. But now they get featured and put on these financial networks. And I'm very, very concerned because I'm seeing the public now come into these things in a big way, and that's always the last level of a bubble, when the public goes into something like that in a big way.
Talking about inflation, I came across this chart, I'm going to show you, and it's the M1 money supply. From 1960 to just before 2020, it slowly rose. And the money supply is money in savings accounts and circulation and money market accounts and such, banks. It rose to $4 trillion at the end of 2019. Look at this chart. Have you ever seen a chart like that? I mean, it's a hockey stick, and it goes straight up. So in 2020, it went from $4 trillion to $18 trillion, and now it's over $20 trillion. So 40% of all money that's out there right now has been created in the last year or so. I mean, that's astonishing.
The last three presidents have seen the national debt rise more than all previous presidents behind. Much of the recovery that we had from the COVID, the 14 days we had to stay in and then everything would be well. And people are going to see that the lockdown is the reason behind the supply shortage, because no one thought of when we stopped everybody from working at all, we stopped goods being made and services being provided. And we're seeing that penalty now. All these things, the political, the social aspects, the division that people are purposely trying to cause Americans to be divided among, and of course the economics, where over 90%, we saw more studies this week come out, where over 90% of Americans continue to struggle or fall behind. That 1 or 10% who mainly have profited from the stock market doing so well, once the stock market does peak at that level, everybody's going to be just about in the same boat. And that's when we're going to see and that's why I said we're going to see something far worse than we saw in 1987, and we're going to see it last far longer than it did from 1987.
As you said before, it's all about debt. We see money creation. I just show you the M1. That's hyperinflation of the money supply, which always happens prior to hyperinflation of goods and services. We're starting to see the beginnings of that, and it doesn't look like the Fed's going to stop this. They say they're going to start tapering their quantitative easing. I mean, the Fed has been printing $120 billion a month and buying treasury bonds and mortgage bonds, trying to keep interest rates down. They stop doing that. Who's going to buy our treasury bonds? Who's going to finance these $5 trillion spending plans and our deficits year over year? If it's going to come from foreigners, they're going to command higher interest rates. The only reason why the 10-year is not 5% or greater is because of the Fed printing money and buying it. But there's a price to pay for that. The price to pay for it is inflation, and we haven't heard that I word for quite some time. And this year, it really did return with a vengeance. And it's just a result of Fed policy of printing money, creating dollars out of thin air that have to find a home. And the home is real estate. The home is stocks, Bitcoin. It'll ultimately be gold and silver. And you just can't put that genie back in the bottle once that money's out there. And to suck it back up would cause major financial dislocation, major recession, depression, or worse, not to mention mayhem in financial markets. So I know it's going to end bad. You know it's going to end bad. We just don't know what the trigger is going to be.
I think we're seeing the trigger. Right? We're seeing the public being brought into. Bitcoin is the AOL of the internet. If you remember the internet, they were coming out with reasons on why a stock would work that we shook our heads. How did they come up with that way of figuring that there was some value to it and all? That industry will implode, just like the internet did. And then in the next world recovery, there'll be bigger and better blockchain companies. But AOL didn't have the advanced technology and suffered from it. That's the same case with Bitcoin. If you are going to look at the coin world, and I'm not here to talk about that, there are much better plays right now than there are Bitcoin. But because so much big money was put into Bitcoin, they need to pass it on to somebody to actually profit from, and that's the public in general right now.
Well, you and I are dinosaurs. I just can't get my mind around Bitcoin and just currencies that have no value that it just created at the end. I don't get it. We mentioned gold before. I know you're been a big believer in gold and silver and real money. We got about 3 minutes left. Are you still bullish on gold and silver? You think that's something we should be looking at?
I think you would agree with this also, and again, please disagree if you don't. After almost 40 years, I've concluded what separates the winners from the losers. It's not how much you make, it's how much you prevent yourself from losing, which separates you from the winners or losers. I wouldn't run out to buy gold and silver just to make money, but I think if you ask me if there's a far lesser of two evils to own right now than Bitcoin or some crazy technology group, that's the interest. And the reason I know it is, central banks continue to be the biggest buyers of it, and two countries which are likely going to be the ones that will lead to taking the US dollar away as the reserve currency, China and Russia, are aggressively buying gold. So I suspect that we'll soon, one of these days, see some sort of new world currency, which will probably be born after this whatever financial crisis is coming happens, and it will have some sort of gold backing so people can have faith in paper dollars again. But it won't be the US dollar. It'll be whatever that China and Russia and some other countries have gone to.
Let's just talk socially for a second, the last 2 minutes we have left here. And it all goes together, financial, cultural, social. I mean, we saw this week a woman raped on a train in Philadelphia. And people, not one person got up to help, not one person called the police. They were filming it, not to give to the police department, for their own entertainment. What is happening to our culture? In a minute.
Well, Lou, my number one reason, I know we're a secular show, but the number one reason that leads to all the other things we decided. America was built on the foundation of a Judeo-Christian principle. Now, there were a lot of faults in it, like you said, Thomas Jefferson had slaves and all, but there was real solid foundation. We've lost that, and we have a group that wants to see it completely wiped away, and that's why people act, as you just said, and would have never acted that same way 30 or 40 years ago.
All right. I wish we had more time. Maybe next time we will take more time and interview you. Peter Grandich, always a great interview. Thanks so much for joining us today on The Financial Position. There's the music. It goes so fast here on The Financial Position. I call it the fastest 2 hours in financial talk radio. Thanks so much for joining us. Remember the website, thefinancialphysician.com, where we have the podcast of this program and past programs. Email address, lou@afminvestments.net. lou@afminvestments.net. My phone number is 732-905-8100. Have a wonderful week. And join me next Sunday and every Sunday for the next edition of The Financial Physician.